Imagine waking up tomorrow and hearing this on the news. Good news, inflation is over. Prices have stopped rising. You breathe out, finally. But then something strange happens. Your salary still feels smaller. Your savings still feel weaker. Your future still feels more expensive. No price tags are changing, yet somehow money is still losing. That uncomfortable feeling, that's not in your head. And today we're going to walk slowly, calmly, and honestly through why money can keep losing value even when prices appear to stop rising. This matters right now because across the world, governments and central banks are celebrating falling inflation numbers. Headlines say things are back to normal. Markets cheer, politicians smile. But households don't feel it. Because inflation ending doesn't mean damage reversing, and stability doesn't mean safety. Let's start simple. Inflation is usually described as prices going up, so it feels logical to assume that if prices stop rising, the problem is solved. That assumption is the trap, because inflation isn't just about prices, it's about purchasing power, how much real life your money can buy. If prices rise 30% over a few years and then stop, nothing resets. That higher level becomes the new floor. Your money didn't heal, it adapted downward. Think of it like a broken escalator. You fell down 10 steps. The escalator stops moving. You didn't fall again, but you're still 10 steps lower. That's where most economies are right now. But there's a deeper layer most people never hear about. Even when prices stop rising, the systems behind money often keep working against it, quietly, relentlessly. Let's talk about wages. Wages don't rise evenly. They lag, always. When inflation surges, companies raise prices fast, sometimes instantly. Wages adjust slowly, through annual reviews, negotiations, delays, excuses. So when inflation finally stops, wages are often still catching up to old damage, which means real income keeps shrinking even in a flat price world. Now add taxes. Tax brackets rarely adjust perfectly for inflation, so when prices rise, even temporarily, people get pushed into higher tax bands without being richer in real terms. That's called bracket creep. It's legal, it's quiet, and it permanently reduces take-home pay. So even if inflation stops tomorrow, the tax system doesn't refund what it quietly took during the climb. Then there's debt. Inflation changes the meaning of debt in strange ways. When prices rise, debt becomes easier to pay back in theory because money is worth less. That's good for borrowers. But here's the twist. Interest rates usually rise to fight inflation, and they don't fall as fast. So even when inflation stops, borrowing costs often stay high, which means new debt becomes expensive, old variable rate debt becomes heavier, and refinancing becomes painful. Your money isn't just buying fewer things, it's renting itself at a higher price. Now let's talk about savings. This is where the illusion really breaks. Most people think their money is safe if prices are stable, but money doesn't sit still. It competes. If inflation is 3% and your savings earn 1%, you're losing 2% per year. But even when inflation drops to zero, something else still matters: opportunity cost. If the economy grows, assets rise, businesses expand, and productivity increases, money that earns nothing still falls behind. Your currency didn't shrink, the world around it grew, so your relative purchasing power declined anyway. That's how money can lose value without prices moving at all. Now let's zoom out. Why does this keep happening? Because modern money isn't designed to preserve value. It's designed to circulate. Most money today is created as debt: loans, mortgages, government bonds. When new money enters the system, it doesn't spread evenly. It flows through specific channels first: banks, governments, asset markets. By the time it reaches wages and savings, prices have already adjusted. This is called the Cantillon effect. You don't need to memorize that, just understand the outcome. Early receivers win, late receivers pay, and savers are almost always late. So even in a low inflation or no inflation environment, the structure itself still favors money movers over money holders. There's also something more psychological happening. Once prices rise, they rarely fall. Businesses resist lowering prices because consumers anchor to the new normal. A coffee that went from $3 to $5 doesn't go back to $3, it stays $5, maybe with a smaller cup. So inflation stopping doesn't feel like relief, it feels like being told to accept a worse deal forever. Now let's introduce the uncomfortable math. If prices rise 10% one year and 10% the next, that's not 20%, it's 21. Compounding works against you on the way up, but it doesn't reverse on the way down. Zero inflation doesn't mean zero damage. It means damage locked in. And here's the irony. Central banks often celebrate price stability once inflation slows, but stability at a higher price level still means permanently reduced purchasing power. From the system's perspective, the problem is solved. From the household's perspective, the loss is permanent. This gap between official success and lived reality is why people feel gaslit by economic data. Now let's address the hype. You'll hear phrases like soft landing, normalization, inflation under control. These are not lies, they're incomplete truths. They describe the rate of change, not the level. It's like saying a plane stopped descending while ignoring it's already much lower than before. And the risks don't stop there. When people feel poorer even during good economic news, trust erodes. Trust in money, trust in institutions, trust in the future. That's when behavior changes. People stop saving, they chase risk, they speculate, they hoard assets instead of cash, not because they're reckless, but because the system quietly taught them that holding money is punished. This creates feedback loops, asset bubbles, inequality, political tension, all from a system where money keeps losing value even when prices appear to stop rising. Now zoom out one last time. This isn't a temporary glitch, it's a feature of modern monetary systems. A system designed for growth, leverage, and flexibility, not stability. And that raises an uncomfortable question. If money keeps losing value even when prices stop rising, then what exactly is money supposed to do anymore? Store value, measure value, or just move value? Because the answer to that question quietly shapes how people live, save, work, and plan their futures. And here's the final thought to sit with. If inflation stopping doesn't restore your purchasing power and stability doesn't mean safety, then the real risk isn't rising prices, it's assuming that normal ever meant fair.